for the invitation. More than, we've stuck to your email where we had to give a general view on the topic and perhaps, poke some people into action and turn their heads into this direction, which we think is kind of interesting and very promising from all points of view, right? We think algo trading and high-frequency trading are, fields that we're going to see a lot of in the press, and we're seeing a lot of it in the press. And we are confident that, this is a space where mathematicians can help a lot, right? If you look at the Financial Times over the last few years, there's been a lot of, bad press about high-frequency trading. People are very jumpy about some of it. Regulation is in place, ready to be fired on the city and Wall Street and everywhere, all the exchanges. And, there's many question marks. There's more question marks than answers. So this is pretty much the outline over a talk. I'll assume, some of you are experts here and have done work in some of these, in this area. I'll assume that not everybody's up to speed, and I'll try and give a kind of broad view of, why are we here, what's going on, and, what could be interesting for some people to look at. So, of course, I'll have to talk a little bit about exchanges because, these have changed a lot, right? And if these hadn't changed, we wouldn't have algo trading and high-frequency trading. So I'll give a couple of examples of, what I think, a classical algo that's been around for a long time. For that, we'll need to talk a little bit about the limit order book and how it works. Again, this is very simple, but if you never thought about the limit order book or how prices clear, it's important that you start to understand that the limit order book is precise. It's really a goldmine for research, and it's also a goldmine for some people who are making a lot of money out of it. So we'll give a couple of examples of an algo trade sort of implementation here. I'll also talk about market making from the point of view of a high-frequency trader, but it could also be from a slow trader. And in the end, I'm hoping I'll have time. I'll talk about market quality, right? Because really, the problem when you read the FT and when you talk to people, in Brussels or in the ECB or in the CFTC or the SEC, these guys are worried about what's happening to the market. Is this thing good to the market? And we have something to say, right? And all right. So, well, Brussels, we know what that is, right? The ECB is the European Central Bank. The SEC is in New York, in Washington, the Securities Exchange Commission, and the CFTC is Commodity Futures and Trade Commission, right? And these are pretty much the last two I mentioned are the watchdogs in the US, kind of similar to the FSA, right? And of course, the FSA has a lot to say about regulation in the UK. So, we hope to help those guys, really. So exchanges, the one that we're really interested in is how things get done today. Most of the pictures one sees, when you look at the New York Stock Exchange, people in the pit shouting and screaming and, flagging things. And, but, that's really disappeared for most of the interesting stuff you do these days. And, what you have is an order-driven market. I'll explain it when I come to the limit order book, but that has already, that big jump from sort of the quote-driven market to the order-driven market is very important because in an order-driven market, lots of people just get together and display their willingness to buy shares or commodities. Most of my examples will be about shares. I'm there sitting saying, well, I'm willing to sell IBA for this price, and lots of people do that, and they sort of send their orders to the book, and then the market clears. And that on its own, is a very important aspect of what's going on. You went from few people knowing a lot about how the market, was functioning and, making markets to a hell of a lot of people who can do it, right? I'll give a very brief definition of algo trading because I'll use it throughout the talk. I'll come back to it again and I'll refine it and make sure that we're clear on what I refer to as algo trading or high-frequency trading. So to me, and and people are still shaping out what this should mean. The use of computer algorithms that make trading decisions, submit the orders, and handle the orders. Right? This is algo trading. It's kind of it could be a black box. It could be sort of your computer at home something that is responsible for handling a trade, handling inventories, which is slightly different from computer-based trading. You know, after all trades are done by computers, right? So we want to differentiate ourselves from, you know, a computer-based trade is slightly different from an algo, which is responsible for a bigger thing. And after all, an algo is coded by humans, right? It's not that human intervention is not there anymore, but of course, it's, you know, you are coding this black box that's doing stuff and handling the trade from its inception all the way to the end. And that's a very important thing. Later on, I'll zoom in for high-frequency trading, which is a subset of this, but you know, for the next few slides, this is what I refer to algo trading. So what has changed? Why algo trading now? Of course, paramount to all of this is computer power. You know, without computers, we couldn't do any of this. So you need that leg for all of this to work. But what's happened in the market? And again, you know, I like Damiano's comment about, it was Dirk's comment about sometimes you need some economic sense. I like your comments too, nothing against yours. That, you know, you need some financial intuition or, you know, understand what's going on. And I think algorithmic trading is that field where you do have the overlap of economists saying lots of, you know, intelligent and sort of intuitive things that in microstructure theory, they've been doing it for 30, 40 years. Then you have mathematicians or people from computer science, you know, executing some of the stuff. And then you have the regulators that when they do a good job and understand the problem, they shape where this boat is really going, right? So here you see a classic example of what regulation has done to the markets, right? So you wanted competition in the market. Everybody believes that competition is great. So you also wanted competition at the venue level, right? So, you know, all of a sudden, you know, a few decades ago, you could only trade in a few places. Now you can trade in many places, right? Now competition is good. You want to give a good deal to the buy and hold investor, to the guy who's doing the IPO. You want to make sure that he can, you know, get a good deal in this venue or that venue. So that sounds all very good, but has fragmented the market a little bit, right? You know, competition amongst venues now means now that you might be able to buy IBM in 10, 20, 30 places, right? So is that all good? It's a completely different talk if you want to think about competition and market fragmentation, but it's an important thing, right? Because it already, you know, you start to think about, well, if I can buy IBM in 30 places, I might as well check the price in 30 places, right? So that already tells you a little bit of what a black box might be doing. You know, you might be searching where is the best price for you to execute a trade. The other thing which, you know, I have as a small bullet point here is that these exchanges compete for business. And the way they're competing for business is to make sure that you put your business through their exchange. So they're giving you rebates, they're giving you incentives, they're giving you sort of special orders that didn't exist. So now you have a fauna of, you know, types of orders, things you can do that you couldn't do, and that again gives you, you know, has to sort of make you think about black boxes, understanding where to go, and the menu of things you can do in different places, and that again makes this a very interesting problem, right? Then direct market access is also, anybody now can trade these days. You can be, you know, sitting somewhere and you know, at home, and you can send a trade through. Of course, if we do it from, you know, through a bank or broker, it might be too slow, but compared to the old days where a lot of it was shouting and screaming and phoning people, now you have a direct, you know, you can link yourself through your broker into the exchange and do a lot of stuff, right? So, you know, serious people can do serious trading, which a few years ago you couldn't do. Then regulation in the US and Europe has been slightly different. You know, I'm just pointing, you know, three things which I think are important for the development of the markets, right? I'm just setting the scene so we understand how important regulation is for algo trading or the way you know, things are going on these days. In the US, for example, the Reg ATS, which is Alternative Trading System, meant that other people that, you know, you can trade at places which are non-exchange venues, right? Causes regulation, you know, how you do it or you don't do it, but, you know, a good example is a dark pool, right? For those of you who don't know what a dark pool is, well, I don't really exactly know what a dark pool is, but it's, you know, these days you have lit markets. You know, the London Stock Exchange is a lit market, meaning, you know, lit, there's light, you know what's going on, there's transparency, versus a dark pool where, you know, it could be a club of people that have a sort of exchange where you can do some trading, okay? And again, is a separate, you know, good thing to look into is to see why dark pools are around when you have lit markets. Regulators are not happy to see dark pools emerging and becoming more and more important, because why would you, in a competitive market, move away from a lit market onto a dark pool? Didn't we want competition and transparency? Don't you want to know what you're getting and why you're getting what you're getting? But it so happens that people are running away from those lit markets to trade in darker ones. I don't mean it's a rip-off, but I just mean it's darker, right? Decimalization and tick sizes, again, when you start thinking about trading and price increments in the stock market, the smaller these are, the more opportunities there might be for these black boxes to find better prices here and there, right? So there's been, again, there's a big debate around what is the right tick size. It's become a regulation sort of question. Smaller tick sizes are good. Is bigger tick sizes bad? What is the compromise? Does it depend on the liquidity of the stock? Small tick sizes would give advantage to black boxes, and so I can talk. Later on, I'll touch upon that on the regulation side. But again, it sounds like a trivial matter, but in fact, it's a very important point for regulators or markets to agree on what the right tick size is, if there is an answer to that question. Then one that people toss around a lot is a Reg NMS, the National Market System of 2005. In the US, they have now kind of a consolidated tape, which is the MBBO, that when you execute a trade, you need to be, your broker, whoever you do it through, guarantees that you're getting the best price around, right? You can't really be executing IBM at 100 when you could have had it at the same, moment in time at, you could have sold it for 101. That cannot happen, right? And then, when you talk to people that are high frequency or algo traders, there's a whole bunch of things they can do to make money out of this thing, right? Yes. Well, the dark pool we can talk later, because they use something as reference, but that reference could be stale, and there's a lot of gaming around this stuff. In Europe, we have, the MiFID, which is the Markets and Financial Instruments Directive, which, they also, they harmonize a little bit how trading gets done. One of the things they've done different from the US is that you're not forced, to contemplate the trade-through rule, right? You might in Europe, you might get a price that was not the best price available when you looked at all of the venues, right? Your broker is not forced to give you the best price, okay? So, all of these things pretty much set the stage for, you have computer power, markets have become fragmented, there's many venues, there's many types of orders you can deploy in the market and try and make money, and of course, that helps a lot in the, development of algorithmic and high-frequency trading. So, why algo trading? Let's just think about one thing that might make you feel that you want to devise a strategy and code it and use a black box to execute some of the trades. Imagine for a second that you're a large, fund, a large investor. You're George Soros, or you're a big manager of a portfolio who has to put through a big trade, buy or a sell trade. And you know that your trade itself is too big for the market to absorb in just in one go, right? And you need to ask yourself, how do I best execute this? I'll give you a little bit of an example later on. But, the obvious sort of reaction is, well, if I have a huge order, if the average daily volume of IBM is 100 and I want to sell, 1,000 shares, well, you just don't want to do 1,000 shares on one go, right? So you just want to break it up. And the question here is, well, how do you break it up? And that'll be one of my examples later on. But, to break this up properly and efficiently, you might want to then have a black box doing that for you, right? So that is kind of an obvious sort of pointer that says, well, you need an algorithm to do this for you and execute it at the best possible price, whatever that means, right? Because, you need to have a benchmark for that, right? So, the easiest benchmark for you to say, well, I had to sell 1,000 shares of IBM, I did it over a week. Well, I want to see the average price I got was 110 or 105 I was selling, but had I sold all of that at the best price when I start executing my trade was X, and the difference is the implementation shortfall and and so on. But the way in which to design the benchmark is very important for portfolio managers, right? Because it would tell you that your algorithm is good or not as good or it's great, right? Sort of the usual suspects when people talk about some of these algorithms are the VWAP, volume-weighted average price, the time-weighted average price, and percentage of volume. So I have them defined here. So some of the things people do is, well, I have a big sort of order. I give it to a broker or to a bank that does this stuff for me, and they just guarantee me that they're going to try and give me the volume-weighted average price. Why is that good? Because you say, well, I go to the CEO or to the CFO or go to my sort of boss and say, well, after all, we didn't get such a bad deal. The average price weighted by volume throughout the day was 100, and we did a sort of around that. So that benchmark itself, sounds okay, right? You just, sometimes it's not that your trade was bad, you just want to do what everybody else did on average throughout the day, right? So you have algorithms, you need to write a code. This is a very simplified version of what I'm telling you what a VWAP is. There's many other things that, banks specialize in beating the VWAP or getting you a much better deal and so on. I just included here a small comment which might be a self-fulfilling prophecy. The problem about the VWAP is that if you are executing a large trade yourself, you will be a big chunk of the volume that day. So, of course, you'll never do poorly if you're benchmarking against VWAP, right? So that's I just wanted to flag that up. You need to predict the volume, and so it's not an easy thing, to deploy in the sense that it sounds easy. We can understand immediately what the VWAP does, but when you're trading, tomorrow you decide to do VWAP for IBM, well, you need to have a sort of estimate of how much trading there will be tomorrow for IBM. The TWAP is, a simpler one, which is I just want the time-weighted average price. So that you can see easily how you phase it out. You just, every 5 seconds or every minute or so on, you just do a chunk of your trade, and at the end you'll be very close to the TWAP. You might also want to do the percentage of volume, so you decide what rate. The problem here is that you don't know what's happening in terms of the volume. Tomorrow you might wake up and might be a day with a lot of volume in the market, or not too many people trading. So you can instead go for the percentage of volume and decide, well, I don't want to be too big, I just want to be 10% of the market or whatever, and you decide on a rate, on a participation rate, and then you just, look at the last few minutes what the volume was, and then you catch up and catch up and catch up, right? So, these are very simple, algorithms that are being used, and of course, you can do a lot of mathematical modeling around them to try and beat it or give your client, if you're a banker, a very good deal. Now, high-frequency trading, again, depending who you talk to will define this in a different way. There's no, in my view, there's no real definition out there. I like, the ones we wrote here are the ones we like and think are, make sense. High-frequency trading is, well, in general, is some prop algos that act at a very high speed. That's all it is. It's high-frequency trading. Some people might want to call it high-frequency quoting. Whatever it is, it's happening very, very fast. And that could be sniping. That could be a guy arbitraging between different markets. You are there and you're very fast, and you can reach every single venue in Europe and the US quicker than anybody else or quicker than most people. Well, you see any opportunity for an arbitrage, and then, if they're selling IBM for 99, and you can buy it there for 98, and so you can immediately, go for a trade and execute it. That, is speed. Or relative speed what really matters. Most of what you see in the press, really, a lot of what you see in the press, also has to do with the high-frequency trading, but in the market-making aspect, which is people who, traders out there who are making market, posting quotes, and they do a lot of this throughout the day and make very little money per round-trip trade. And again, I'll give you an example of that later on. But what is different here? Well, again, you need a lot of speed, but these strategies are, again, acting on super speeds compared to the rest of the traders. And one of the things which I think is the hallmark of a high-frequency market making strategy is that if you look at the inventory of these guys, they hold their positions are very, very close to zero throughout the day, right? And that's why I wanted to make the difference. Why do some of these get bad press? Because, well, they cancel most of the orders they send to the book. Depending on the stock and the venue, you could be talking up to 98% of the orders these guys send to buy and sell are canceled immediately, right? 98%, 95%, 99%, right? So now what we want to do is show you, two bits of mathematics which are simple, but tell you what people are doing in this space. One will be on the sort of algorithms that execute large trades, and the other one, the market-making problem. But before that, we need to, talk a little bit about the limit order book. For those of you who have never thought about it, well, initially, studied finance there many years ago now, I always saw a price, right? And you get a Brownian motion, that's a price. Well, in fact, when you want to buy, it's like, you landed at an airport and you want to buy dollars, they'll give you a quote, or if you want to sell dollars, they give you a different quote, right? Well, that's exactly the same here, right? So the limit order book is, a place where all orders are accumulated from all market participants. People are willing to buy or willing to share, to sell X amount of shares for whatever price. And then all of those are sitting in a book. These are passive orders, waiting for a more impatient guy who's going to execute a market order, right? So you land at the airport, there's 100,000 people there trying to sell you dollars or buy dollars from you, and you are the market order who says, well, I want to buy $100 at whatever price, the best price I can find. That is a market order. So this is pretty much a simplified version of what a book looks like. So the buy side of the book is everybody sitting here saying, well, I'm willing to buy shares at these prices, that volume. That's the sell side of the book, and that's pretty much what you care about, right? But let me just show you a small film, if I can, of the limit order book for PCP. I can't remember what PCP, Parts Corporation, something. This is, I don't know if this is going to load, right? So if this thing loads up, it's a snippet of the limit order book. Well, I don't think it's going to come. Oh, yeah, there you are. So this is 21st of June, 2011, NASDAQ data. This is the book for NASDAQ, for PCP. Every time you see an update is a millisecond. So take a second, divide it by 1,000, and it's trimmed the book to the left and to the right. So these are all everybody saying, I'm willing to buy, I'm willing to sell. And that's kind of interesting, right? A lot of people just make money by understanding what the hell is going on here, right? One thing that you would like to think about is look at the depth of the book at the touch, which is the closest to the mid price. If you see that price and you don't see the volume, you think there's a good deal, right? But in fact, there's very little volume, right? And what's going on here, I just couldn't flag it, but most of these updates are cancellations. 99% of the stuff you see here, every time a book changes, is people repositioning. It's not a market order. It's not a guy who landed at the airport and bought some dollars or sold some dollars. No, it is just those black boxes repositioning their orders in the book.
Why do you think the bid-ask spread is so wide?
Why is it so wide? Well, depending who you ask, they will say it's not too wide, right? But the bid-ask spread will explain many things. Market makers, there's asymmetric information, there's the volatility, there's too much volatility. You want the wider spreads. So after all, market makers, in the traditional sense, make money from round-trip trades, right? You just want to buy the share and turn it over later on, and for that you're compensated by the spread, right? So that is the question regulators are asking. Are these spreads good or bad, or is there anything else you had in mind?
I would expect that if I wanted to sell something, I would go to the head of the line just before.
Yeah.
But you don't see anybody there.
Well, and I tell you why. Because most of these guys are high-frequency traders who are there positioning themselves at the sort of front of the queue, ready to pounce if they see something. If they don't like it, they withdraw and they reposition. You know, but I don't know. That it's just my, you know, I hesitate to answer that one because I can build a book. I don't know who's trading, right? But the question people are asking themselves is, why is that front of the queue, so, you know, the volume not as high? What is not as deep? Why is it changing so much? You know, if you're a guy who really wants to sell dollars, you just post it and wait until it gets executed, right? I'll come back to some of those regulation points later on. Let me see if I can. So where was I now? Okay, so what you saw, this is pretty much what goes on. So when a market order arrives, very seldom, you know, compared to that millisecond start, you know, sort of book I showed you. Let's say a buy market order arrives, goes into the sell side of the book. If it was a large order, it chews up, you know, a few of this. So, you know, this guy wanted to buy dollars, saw that price, went for it, but he ended up getting, you know, a good price that he thought initially, and then a slightly worse price, and then slightly even worse price on the other one, right? So you're eating into the book depending on. All right, the thing stopped working. Could it be that this is chewing up memory? Let me just close this. Right. Right. Did I switch this thing off? Perhaps, I don't know. So the buy market order arrives, eats into the book replenishes, right? And there you are, right? The interesting questions are, well, how long does it take the book to replenish? You know, is it repositioned and people cancel and so on? That's, you know, that's okay. You know, nothing is different. So far I haven't told you anything different from what you usually saw many years ago. The question now is the speed at which it happens and who's actually in the book, and if what you see is what you get, and if what you see is not what you don't get, what is it that you get when you actually send a trade, right, to the book, right? That's what, you know, that's one of the things that, you know, people do worry about. So now I'm going to give you the first example as to why you would want to, you know, have an algo, right? So if you're a guy who wants to send a large order as a buy or a sell, you need to rebalance your portfolio, and you do need to, you know, put through a big trade. You know, intuition already tells you don't want to do it all at once. You need to break it up, right? But let me show you, you know, what is the thing that makes you think about this. This is again 21st of May. Netflix is not PCP. Netflix. June, you know, just Nasdaq data. So at a particular point in time, that's how the book looks. Doesn't look too healthy on the sell side. And you ask yourself, if I stop the world there, and I send a buy order of 100 shares, what do I get? Well, perhaps you just get the best quote. You're happy with that. But if your order starts to increase, the average price per share starts to go up. Okay? So that's you know, that's kind of a market impact. This is not really market impact in the sense of what I'll discuss later on, but you know, by looking at the book and the depth of the book, you know that sending an order which is 100 shares or 200 or 300, you'll end up getting, you know, a price impact per share which is, you know, gradually growing up, right? You see it here for the sell side and here for the buy side. I don't know if they stopped working. Hold on, yeah. So if I were to do for the 21st of May for Netflix on Nasdaq data, if I have 1 minute worth of data here. So I take 1 second, do exactly the same exercise as before, and draw a line, okay? I wait another second, ask myself again, if I were now to execute a volume of 100, 200, 300, 400, or 500, I think this is buy side, what do I get? So I draw 60 of these, right? And the blue dots here is pretty much the average. So, you know, even within a minute, you could get a completely different price for shares you bought. You know, if you were buying 500 shares is not a lot, right? You know, so this is measured against the best quote. So sometimes you do very well like that. You know, if you pick that second, you know, millisecond, you did very well. Otherwise, you end up, you know, paying a lot more per share on average, right? So if I take the average over the minute, is the blue dot. If I kind of fit a straight line, just to give myself an indication, well, over that minute, what will the market impact have been? Well, this is what I see. Again, the market impact here is very trivial because I'm not taking into account really that the market might react to my sort of trades and change stuff. So if I do that throughout the whole day, you'll see that the market impact. So I do, every minute I'll take the average of the 60 seconds and then, fit a straight line and then just put a dot here. You'll see that the market impact throughout the day varies a lot. And again, this is kind of a toy version, Mickey Mouse version of what the market impact might be, because really, a lot of these if you have a huge trade that you're breaking up throughout the day, you will eventually get detected by other black boxes that will just, trade ahead of you and reposition themselves in the book, and you'll hurt even more. So if anything, this is a huge underestimate of what a large order might do when you try and execute it. So this is a classic algorithm. This is pretty much the seminal paper of Robert Armgren and Neil Chris, in a slightly different setup. So how do you optimally liquidate or acquire a position, right? So how am I with time? Because I don't...
if you can...
Okay, well, I'll say, because I do want to get to the last couple of slides. So, the optimal liquidation algorithm, you pretty much, have a large amount of shares to buy or sell. You have some market impact. You hurt yourself. Every time you trade, you hurt yourself. You chew into the book, and if you're detected, then the fundamental price of the asset is also affected, right? And that is a lot of people are trading by trying to figure out that there's a big order coming through, and then there's a temporary pressure on the price, and then they make money out of you. Of course, when you're actually doing the trade, you want to maximize the money you get out of it if you're selling, or how much you minimize the amount you're paying if you're buying. So
Alvaro, so in what you showed before, you showed essentially discrete system, and then this model switches without any explanation to diffusion. So the complex.
Well, but that's, I don't know if you have thoughts on that. I'm just showing that the Armgren paper, and it's true, right? I'm using a diffusion for the mid price, and that might not be the right thing. So over a short period of time, I'm happy with that. But I don't have really, the answer as to what's best in terms of, this is very easy to solve, and I do it in closed form, and that's why I have it there, right? And truly, if you see the picture of PCP, the mid quote doesn't actually move like a diffusion like I just showed there. But, well, there's some optimal ways in which you can do it. I'm not going to spend time on that. I'm going to then show you a little bit of the market making problem. Again, a toy model, you can make it as complicated as interesting. So again, now imagine, so I'm going to, in the interest of time, I don't know if I'm falling behind too much, but in the interest of time, this is the question you're asking yourself. Now imagine for a second that you are the guy who's posting orders in the book. You need to ask yourself, well, I have a very cool black box, can do a lot of stuff. I can access the market very quickly to send orders and cancel them if I think that's not where I want to be in the book. So you're basically asking yourself a simple question. It's a very simplified version of life. Where do I put my limit orders in the book? I'm willing to buy that amount of shares at this price. I'm willing to sell that amount of shares at this price. How do you optimally do that? And again, set up the problem and solve the HJB and give myself some optimal postings. But I want to spend some time here so I can wrap up, because I think the slides, you can access them. The mathematics of all of this is fascinating, and there's a lot of work being done here. And there's space for dozens of PhDs in this area. So I have a couple of more slides, which I think we can help shape regulation. And we, as mathematicians, we can sort of shed some light onto what's going on and why do we see that what might happen if what they're trying to do is really implemented. I'm not going to give an answer to all of those things now, but I'm just going to tell you, first of all, has the market really improved? Right? That is a topical question, and there's 5 papers and 8 answers, which I find incredible, right? So like economists, right? So most of these papers are being written by economists. So is high-frequency trading and all of these sort of black box trading or computer-based trading any good for the market? Well, first of all, you need to ask yourself, well, what do I mean by good or evil here, or good or bad, or not too good for the market? So what is the right measure for the quality of a market? Well, spread used to be one. Tighter spreads meant a healthy market. Well, it's not actually true, right? You see the PCP picture I showed you. You saw very tight spreads, but very little volume at the touch. You don't like that. So the effective spread is a different one. The effective spread is I actually send a market order, I get a price, and compare that to the mid quote I was seeing at a time before. I can choose, you know, a millisecond or a second before, because it's effectively what you get. You know, it's what you get compared to what you thought you were getting. That's what the effective spread might tell you. The market depth, the one I kind of think is very important, is, well, now that I can see the book, I want to see a lot of depth. I want to see resilience. I want to see a book that when a big order comes in will not really hit all the way into the tail of the book, right? So you want to see whether having everybody there being able to access the market, whether it is a deeper book, right? Then volatility, another measure is are prices less volatile these days than before because these guys are around? And then for an economist, it's also very important the price discovery, right? This is just telling you whether the price that you see reflects the true value of the company you're trading. That's a very important question. For us mathematicians, we just sometimes don't see anything but a price or a Brownian motion or a Levy process for the price. But for an economist and for welfare, it's important to see that the market is sending the right signal to stakeholders that this is the value of the company, right? And is this true? I don't have answers to all of those, but I'm just trying to motivate things that some people might want to work on. I'll give you 3, I like 7 papers out there, and all of them have completely different answers. I'm citing one of mine here. So a read that I do recommend is the SEC CFTC concept release. You know, after the flash crash in 2010, they released this report, and it's kind of fascinating, right? Because they do have prop data, they know who was trading what. And that, you know, that goes on to say high-frequency traders did not cause the crash. They might have exacerbated the effect of it, but it's a very small sample over 3 days and just the E-mini they study and so on. But it's a very good read. Then Hasbrook and Saar, you know, for those of you who know the financial economics literature, this guy is, you know, it wouldn't surprise me if he gets a Nobel Prize. You know, they look at NASDAQ data, the H data over 5 years, and then look at whether low latency trading, you know, latency meaning the time it gets you to send an order to the market and get an acknowledgement, saying, well, have these guys done good or bad to the market? And they find that effective spread and so on, and the displayed depth, you know, has improved over the last few years. We have a paper which is using the same data, and we prove completely the opposite. You know, it's a different proxy for high-frequency trading. We, in fact, show that depth in the limit order book has decreased when you have these guys around. The effective spread goes up, which is a bad sign, and the quoted spread also goes up when you have more high-frequency trading throughout the day, right? This is not a general, this is just saying, condition on the fact that there's a lot of high-frequency trading, this is what you see. And that's just to poke some of you guys into action. I tell you, you know, if there's this thing that there's 5 papers and 8 different opinions, you might want to write your own.
I note that you do not quote the UK government's foresight review.
I wrote one of the drivers,
Yeah.
right? So I'll come onto that now. So, so what is wrong with the high-frequency trading? So this is pretty much what they're trying to do, right? Let me see. Yeah, this is my last slide, and it's a very important one. So regulation, you know, is out there trying to medicate a patient that you cannot give a good diagnosis of. You know, I want to medicate you, but I don't know what's wrong with you. That's how I view this thing. You know, whichever way you want to see it, it's kind of odd, right? So, as Rama mentioned, the Foresight Group, you know, spent millions of pounds hiring people. I didn't get much money for that, but I wrote one of the drivers for high-frequency trading to say, well, what do we think about what MiFID is trying to impose, right? Some of the questions, what they're trying to do is the following. So minimum resting times. That is a very, very good mathematical problem. This piece of regulation says the following thing. I want to force people who send orders to the market, to the book, to stay there for X number of seconds or milliseconds. I'm going to force you to provide liquidity for a minimum amount of time. Depending who you talk to, this is a terrible thing, right? If you cannot cancel an order, if you cannot withdraw something, you might not as well then provide it. So you might end up seeing spreads going up because of this particular rule, and what is the minimum amount of time. So all is like throwing sand in the wheels of the high-frequency traders. All they're trying to do is stop guys from sending limit orders to the book that they immediately cancel, right? Because then what you see is not what you get. And again, I have no particular position in all of these in public. In private, I do. Right? I'm being recorded. So market-making obligation is force people to make markets. If the market is taking a huge tumble, you're forced to make markets. And they don't say anything about the spreads you can post, but they want to make sure that the market is resilient, something goes wrong, and people can still buy and sell stuff. Oh, no. Another one, and if you think about these are all mathematical problems we can pose, right? Solving them is really a little bit difficult, right? Execution to message ratio. Rather than having minimum resting times, I'll penalize you if you send too many orders which are cancelled when I compare it to the amount of your orders that were filled by market orders, right? So that is yet another one. In Italy, for example, they're implementing that, but the fine only kicks in after a super pressure that no one really reaches yet, but that's an idea. The tick size is a very, very important one. What is the right tick size? What I said at the beginning, a small tick size will be good for high-frequency traders because the price-time priority in the book is violated. Like Temu said, I really want to sell, I get to the front of the queue, but the cost to you is the increment in the tick. So if it only costs you 1 cent divided by 100 just to get ahead in the queue, well, all the high-frequency guys will do it. We'll be there, and what is the equilibrium? The question there is, well, the slow traders might already know that, and then they won't just even bother to pose, because anything they put in the book will be, outraged immediately by a guy like Temu, right? And then you might not want that. And again, that is, again, a question. What is a good mathematical question? Well, how does the market-making problem change? And as a whole, in equilibrium, what is it that you end up getting as a result, right? One which I find really, circuit breakers, that's one where if the market is taking a tumble, you stop the markets and you harmonize them. So no one would disagree with that. I love this one, is can we have your algos? Whatever that means, right? You just send them a CD with music and then they'll try and implement that, right? All right, I just copied that twice. The other one that is also being proposed is a call auction and continuous trading. Is rather than having continuous trading, or most of the exchanges open the day with an auction, right? So a lot of people pretty much say what they want to sell and so on, and then you have a call auction. We'll have many of these throughout the day. Okay, so that again seems an interesting idea. The implementation doesn't seem as easy. And I've listed a whole bunch of papers. I'm hoping I didn't leave anybody. I've let some people out because we spent the time putting the slides together rather than looking at our bib tech file of the papers we'd read. But there's plenty of literature on the topic, and some of the people are sitting here who have written about that. So I don't know if I ran, if I did a Damiano with a 10-minute run, but that's pretty much all I have to say.
Any questions for Alvaro?
Could I make a remark? You need to go for your lunch, otherwise it'll be past its sell-by date, I think.
I also need to advertise.